You owe money. That's not unusual. What is unusual is this. Somewhere, right now, your debt is sitting on someone else's balance sheet, listed as a high-quality asset. Not metaphorically, not philosophically, legally, mathematically. Your obligation is their security. And once you see how the system is designed around that idea, it becomes very hard to unsee. Because this isn't about irresponsibility. It's not about bad choices. It's not even about interest rates. It's about structure. And that structure quietly shapes who gains leverage and who never quite catches up. Let's start somewhere uncomfortable. When you borrow money, you're told a simple story. You need something now, you don't have the cash. A bank steps in. You pay them back later with interest. Clean, symmetrical, fair. But behind that clean story is a very different reality. To you, debt feels like a weight, a monthly obligation, a limit on future choices. To the institution on the other side, that same debt is a productive asset. Not because they hope you pay, but because the system is built assuming you must. Here's the first quiet twist. Banks don't treat loans as money going out. They treat loans as money being created. When you sign a mortgage, the bank doesn't hand you pre-existing cash from a vault. They create a new asset on their books, your promise to pay. That promise is now something they can use. They can count it as capital. They can borrow against it. They can bundle it. They can sell it. They can insure it. They can leverage it. Your future labor has just been converted into present-day financial machinery. And this isn't a side effect, it's the core feature. Think about the absurdity for a moment. You take on risk for decades. The bank books profit immediately. You worry about job security, health, inflation. The loan is already doing work for them. And if something goes wrong, well, we'll get to that. But first, zoom out. Why does this matter now? Because debt isn't just higher, it's become the dominant fuel of the entire system. Households, corporations, governments, everything runs on leverage. In the past, debt was a bridge. You borrowed to build something productive, then crossed to the other side. Today, debt is the destination. The economy doesn't just tolerate debt, it requires a constantly expanding supply of it. And that means someone, somewhere, must always be on the hook. Usually, you. Here's how the mechanism actually works, step by step, without jargon. You borrow money. Your debt becomes an asset to the lender. That asset earns interest. Interest becomes predictable cash flow. Predictable cash flow becomes something investors crave. So that loan doesn't just sit there. It gets packaged with thousands of others, turned into a financial product, rated, traded, used as collateral for even more borrowing. By the time you've made your third payment, your loan may have changed hands multiple times. You're still paying, they're still collecting, but the original lender may already be gone. This is where the math gets uncomfortable. The system doesn't need everyone to succeed. It just needs most people to keep paying most of the time. Defaults aren't bugs, they're modeled. Losses are expected, priced in, hedged. In some structures, failure can even be profitable. That's not cynicism, that's design. Remember the financial crisis? Millions lost homes, jobs vanished, savings evaporated. But many institutions didn't collapse because people defaulted. They collapsed because too many defaults happened at once, faster than the models predicted. The problem wasn't moral failure, it was correlation risk. The system wasn't shocked that people failed, it was shocked that they failed together. That tells you everything. Now, let's talk about the quiet irony. You're often told debt builds your future. A home builds equity. Student loans build earning power. Credit builds opportunity. Sometimes that's true, but structurally, Debt builds balance sheets long before it builds lives. If you pay on time for 30 years, you're responsible. If you struggle, you're risky. But in both cases, your debt served its purpose. It existed, it generated yield, it supported leverage. The moral language comes later. Here's another uncomfortable layer. Debt flips the power dynamic of time. You live forward, they get paid up front. You absorb uncertainty, they convert it into probabilities. You experience volatility emotionally, they smooth it statistically. This is why debt feels personal, but is managed impersonally. You lose sleep, they adjust a model. And this is where hype and reality split. The hype says debt is neutral, a tool, a choice. The reality is that debt concentrates upside and distributes downside. Those who already have assets can borrow cheaply, invest, and amplify returns. Those without assets borrow expensively just to participate. Same system, different outcomes. One group uses debt to scale wealth. The other uses debt to survive. And the system counts both as success as long as payments continue. Zoom out further. Governments run the same playbook. Treasury bonds are just institutionalized debt, promises to pay, sold as safe assets. Your taxes support them. Global investors depend on them. Entire pension systems balance on them. Debt isn't the shadow of the economy anymore. It is the economy. And here's the risk almost no one wants to say out loud. When an economy depends on debt expanding forever, stability becomes fragile. Growth slows, rates rise, incomes stall. The pressure doesn't release upward, it presses down. More payments, longer terms, new products to keep the machine fed. Buy now, pay later, refinance, roll over, extend. Not because it's good for you, but because the system needs the asset to exist. And yet, you're still told the same story. Work harder, budget better, be responsible, as if the problem is individual discipline inside a structural design. That's the quiet absurdity. If everyone paid off their debt tomorrow, the system would seize. Banks would lose assets, markets would lose collateral, liquidity would evaporate. Your freedom would be their crisis. So ask yourself this, in a system that needs you to owe, how likely is it that freedom from debt is the intended outcome? This isn't a call to panic or revolt or stop paying. It's a call to see clearly. Because once you understand that your debt is someone else's asset, you start asking different questions. Who benefits from expansion? Who absorbs contraction? And what happens when the math finally outruns the story? That's not a rhetorical question. It's an open one. And the system hasn't answered it yet.